All right, let's jump right into this explainer and see how a completely unexpected geopolitical shock took a seasonally slow quarter and turned it into a massive long-term opportunity for Flex LNG. Welcome to the breakdown. Today, we're unpacking Flex LNG's first quarter 2026 results. If you follow LNG shipping at all, you already know it's a sector that is incredibly sensitive to global supply chains and world events. And wow, Q1 was a textbook example of just how incredibly fast things can change. Here is our roadmap for today. We're going to hit the Q1 financial snapshot, talk about the massive macro market disruption, look at their fleet contract strategy, break down the balance sheet, and finish up with those consistent dividend returns.
Starting off with Section 1, the Q1 financial snapshot, and how they navigated a seasonally soft quarter.
So looking at the numbers, historically, LNG shipping always sees a bit of a lull as winter heating demand drops off, right? And, well, this year was no exception. We saw revenue come in at $80.5 million. That's down a bit from $87.5 million in Q4. Net income followed suit, dipping down to $19.5 million. Oh, and basic earnings per share, that contracted slightly to 36 cents. But wait, why the dip? Well, it honestly wasn't a surprise. Flex LNG actually scheduled dry dockings, that really heavy essential maintenance, for two of their ships, the Flex Volunteer and the Flex Freedom, early in the year. When those ships are in dry dock, they're obviously not making any money, but the bills keep coming. Add in a super soft spot market early in the quarter, plus higher fuel costs to position those ships, and yeah, that perfectly explains the modest drop. So really get a grip on shipping revenues, though, we gotta talk about TCE, or time charter equivalent. Think of it like renting out a car. Your true profit is what's left over after you pay for the gas and the tolls, right? TCE is the exact same thing for a ship. It's the net daily take-home pay after you subtract voyage costs like fuel and port fees. It is totally crucial for comparing apples to apples across different ships and different times of the year. And here's the kicker. Even with those dry dockings and that sluggish early market, they still pulled in a highly profitable fleet-wide TCE of $65,729 per day in Q1. Sure, it's down from the 70 grand range we saw in Q4, but maintaining nearly $66,000 a day during the seasonal trough, that just proves how resilient this fleet really is. Moving right along to Section 2, the macro market disruption, or a dramatic twist in the Middle East. Now, Q1 wasn't just about scheduled maintenance. We have to talk about the wild card, a massive geopolitical shock that literally flipped the script for the rest of the year. Early on, spot rates were practically asleep, sitting down in the low 20,000s. But then, late February hits. Middle East conflict escalates. Qatar's Ras Laffan complex gets hit with outages and the Strait of Hormuz is disrupted. We're talking about 1/5 of global LNG export supply just temporarily vanishing. Buyers absolutely scrambled, causing a totally unprecedented dislocation in the shipping market. And wow, look at this. We saw the largest month-on-month jump in spot earnings on record. Rates went from a sleepy $30,000 a day to skyrocketing over $250,000 per day. No joke. Now, they have settled back down to around 85 grand since then, but the whole baseline of the market just shifted way up. Because of that tighter market, Flex LNG didn't just sit back. They confidently raised their full-year 2026 guidance across the board. They bumped expected revenues by about 10%, aiming for somewhere between $345 and $370 million. Adjusted EBI, also up 11%, now targeting $255 to $280 million. That macro shock basically turbocharged their whole year. Which brings us to Section 3, Fleet Contract Strategy, locking in multi-year security. So management saw this sudden strength and played the long game. They didn't just blindly chase those crazy spot rates. Instead, they shielded themselves, and you, the investors, with massive contract coverage. Check this out. For the rest of 2026, they are sitting on 91.2% firm contract coverage. Only 8.8% of their days are actually exposed to the spot market. Talk about limiting your downside risk if things cool off again, right? And how did they pull that off? By striking while the iron was hot. The Flex Aurora grabbed a new 2-year firm charter that could actually stretch to 8 years. A supermajor locked in the Resolute and Courageous all the way out to 2032. And the Flex Constellation? It just started a massive 15-year charter running to 2041. Add it all up, and their total firm backlog is an insane 54 years across the fleet, and potentially 81 years if all options are exercised. I mean, that is the literal definition of cash flow visibility. All right, on to Section 4, balance sheet breakdown, looking at their underlying financial health. Because look, a great backlog is awesome, but you absolutely need the balance sheet to back it up. As of March 31st, 2026, they are sitting on a very healthy cash pile, nearly $400 million, $389.1 million to be exact. That liquidity makes it super easy to handle their $1.8 billion in long-term debt. Plus, that debt is backed by over $2 billion in hard assets, their incredibly advanced fleet of vessels. Now, holding $1.8 billion in debt means floating interest rates can be pretty scary. So what do? Interest rate swaps. It's exactly like refinancing a sketchy variable rate mortgage into a rock-solid fixed rate. Flex LNG swapped their floating rates for a fixed rate on $775 million of their debt, locking in a totally comfortable 2.46% for the next 2.5 years. So they're perfectly shielded from unpredictable rate hikes. Finally, Section 5, consistent dividend returns, or as I like to call it, the income investor's journey. Why does all this operational maneuvering and financial structuring actually matter to you? Well, for a lot of folks, this right here is the main event. Thanks to that massive contract backlog we just talked about and their heavy cash position, the board declared a quarterly dividend of 75 cents per share. But here's the crazy part. This is their 19th consecutive ordinary quarter at that exact 75-cent level. That kind of consistency is exactly what income-focused viewers are hunting for. Zoom out a bit, and the scale is just huge. Throw in the special dividends alongside the ordinary ones, and Flex LNG has handed back a staggering $810 million to shareholders since 2021. They're proving, quarter after quarter, that returning capital isn't just an afterthought, it's practically in their DNA. So let's wrap this all up. Management basically pulled off a flawless combo this quarter. First, they navigated the seasonal sluggishness of early Q1. Then, when the macro shock hit the Middle East, they didn't just grab quick spot cash. They played it smart and locked in multi-year security. And through all that chaos, they kept those shareholder yields incredibly strong and reliable. But here is the million-dollar question we have to leave you with today. The disruption in the Strait of Hormuz totally flipped the math for 2026. But is this geopolitical tightness just going to fade away as global supply chains reroute? Or are we standing at the very beginning of an entirely new structural supercycle for LNG shipping? You're definitely going to want to keep your eyes glued to those spot rates and global export volumes over the next few months to find out. All right, thanks for joining me for this explainer, and I'll catch you on the next one.